Welcome to episode 25 of Nova Bourse. Today, we are tackling a fundamental challenge in technical analysis. Stop getting lost across timeframes. Many traders suffer from a lack of clarity because they try to make sense of the market on a single screen. We are going to build a top-down system specifically designed for the United States financial markets. By the end of this session, you will understand how to organize your charts into a logical hierarchy, ensuring that you are not just reacting to noise, but following the professional path of least resistance. Let's get started. Every trader has lived this nightmare. The 15-minute chart screams buy, the daily chart whispers sell, and the weekly chart says absolutely nothing at all. You freeze, or worse, you click, and then you regret it. Multi-timeframe analysis exists to solve this exact paralysis. It is not about cluttering your screen with more indicators. It is about reading the same market through different lenses, with each lens tuned to a different speed of participant. Without this discipline, you're not really trading. You are just guessing which pieces of market noise actually matter. If you want to stop feeling overwhelmed, you have to learn how to layer your perspective. The data backs up this approach. A 2021 study published in the Journal of Technical Analysis found that trades aligned with the trend on at least two timeframes achieved a 67% success rate. Contrast that with trades based on a single timeframe, which managed only 49%, essentially a coin flip. Furthermore, a 2022 survey of 200 professional traders found that 94% use at least two timeframes, while 68% use three or more. The professionals aren't doing this because it looks sophisticated. They do it because the math proves that it works. We are going to focus on a four-layer top-down approach: monthly, weekly, daily, and 4-hour. The monthly chart answers one question only: what is the secular trend? The weekly chart refines that into actionable market structure. The daily chart helps you identify the setup zone, such as pullbacks or breakouts, and the 4-hour chart delivers the precise entry and exit trigger. You never start at the bottom. Starting at the 4-hour chart is like trying to choose a vacation destination by inspecting a hotel room before you even know which country you are in. Always work from the top down. Alexander Elder, who developed the triple screen system in 1985, proposed a simple ratio. Each time frame should be 4 to 6 times longer than the one below it. If your execution chart is the 4-hour, your setup chart should be the daily, which is a 6-to-1 ratio. Your trend chart should then be the weekly. Research confirms this isn't arbitrary. Time frames fewer than 3 times apart produce about 90% redundant signals. Conversely, time frames more than 8 times apart drop contextual overlap below 40%, creating a disconnect between what you see and what it actually means for your trade. Alexander Elder was a psychiatrist in New York before he became a trader, and he built the triple screen system to resolve a specific paradox. Trend-following indicators work in trending markets but fail in ranges, while oscillators work in ranges but fail in trends. His solution was to assign each tool to a different time frame rather than forcing them to coexist on one chart. Screen 1 identifies the tide, or the major trend. Screen 2 identifies the wave, which is a temporary pullback. And Screen 3 identifies the ripple, the precise moment to enter. This architecture is the DNA of every modern multi-timeframe method. Screen 1 uses a time frame 5 times longer than your trading chart and applies a trend-following tool. If you're a swing trader using the daily chart as your intermediate view, Screen 1 is your weekly chart. The goal here is binary. Is the tide rising or falling? A rising tide means you only look for long setups, while a falling tide means you only look for shorts. There is no third option. If the weekly MACD histogram is rising, or if price holds above a long-term moving average, the tide is bullish. You do not hunt for entries here. You are simply waiting for permission or a denial. Screen 2 drops to your intermediate time frame for most swing traders, the daily chart, and uses an oscillator to detect pullbacks against the tide. If Screen 1 says the weekly trend is up, Screen 2 waits for the daily oscillator to dip into oversold territory. That dip is the wave, a temporary counter-trend move that offers a lower-risk entry. You're not trying to catch a falling knife. You are waiting for the larger trend to inhale before it exhales again. The exact oscillator matters less than the discipline of only taking signals that align with the direction established in Screen 1. Screen 3 is the execution layer. Once Screen 1 grants permission and Screen 2 identifies a pullback, you drop to the 4-hour chart for the actual trigger. Elder originally used a trailing buy stop one tick above the previous bar's high. In modern practice, this might be a break of a 4-hour consolidation, a close above a short-term moving average, or a reversal candle at a known support level. The key principle is that the entry must confirm the pullback has ended and the trend is resuming. Without this confirmation, you are simply buying a dip that may keep dipping. Not every trader needs the monthly to 4-hour sequence. A position trader holding for months uses monthly for trend, weekly for setup, and daily for entry. A swing trader holding for days to weeks uses weekly for trend, daily for setup, and 4-hour for entry. An active day trader uses daily for trend, 60-minute for setup, and 15-minute for entry. A scalper uses 60-minute for trend, 15-minute for setup, and 5-minute for entry. The swing trader combination of weekly, daily, and 4-hour has produced the most favorable risk-adjusted returns in backtesting, capturing roughly 80% of significant moves while remaining manageable. Let's look at a case study, the S&P 500 monthly chart in 2022. The index fell 19% that year. On the monthly chart, the index closed below its 12-month exponential moving average for the first time since the COVID crash. That was Screen 1 screaming that the tide had turned. Any trader starting their analysis on the daily or 4-hour chart that year saw rallies and bounces that looked like bottoms. But the monthly chart framed every one of those as a counter-trend move within a larger downtrend. The top-down approach would have saved you from buying every dip in a year where dip buying was punished repeatedly. In 2023, the S&P 500 rebounded 24%. While the monthly chart's 12-month EMA was still sloping downward in January, the weekly chart told a different story. A series of higher lows forming since October of 2022, with the index reclaiming its 40-week moving average by early February. This is where the weekly time frame earned its keep. It caught the trend change 2 to 3 months before the monthly chart confirmed it. A swing trader using weekly as Screen 1 would have started hunting long setups by February, while a position trader waiting for monthly confirmation entered later with higher conviction. Both were valid. You just need to know which time frame you are following. Consider the stock Bath & Body Works, ticker BBWI. The stock crashed approximately 70% from its November 2021 high of $82 to a low of $25.75 by June 2022. From that low, it entered a consolidation phase on the weekly chart, chopping sideways for 17 months. In late November 2023, the stock printed a positive crossover on its 12-week simple moving average. That was Screen 1. The weekly tide was potentially shifting from down to up. There was no entry yet, just a reason to pay attention to the chart. Following that weekly crossover, the daily chart on BBWI confirmed with its own positive 10-day simple moving average crossover in early December 2023. Price also closed above a descending resistance trend line that had capped every rally since mid-2022. Screen 1 said the tide was rising. Screen 2 said the wave had pulled back and was turning. Dropping to the 4-hour chart, a momentum indicator called the No Sure Thing printed a positive crossover. Entry on that signal would have captured a rally of approximately 27% over the following 3 weeks. The exit signal came from that same 4-hour indicator just before Christmas. After the Christmas exit, BBWI pulled back from $46 to $40.91. On the weekly chart, the 12-week SMA held, meaning the tide was still rising. In late January 2024, the 4-hour No Sure Thing indicator printed another positive crossover. This second entry yielded approximately 7% before a negative crossover at the end of February signaled an exit. Then, in early May 2024, after a second positive weekly crossover near the $50.30 resistance level, the charts aligned again. That entry produced a 5% move in 2 weeks. 3 separate entries, all filtered through the same process, all requiring alignment across weekly, daily, and 4-hour charts. A confluence zone is a price area where multiple timeframe structures overlap, such as a weekly support level that aligns with a daily moving average and a 4-hour consolidation floor. These zones are not coincidental. When a support level from your highest timeframe overlaps with a setup signal on your intermediate timeframe, the probability of a successful trade increases significantly. Research on multi-timeframe support and resistance confluence suggests success rates improve by 40 to 50% compared to single timeframe analysis. The confluence zone is where you place your entry, your stop loss, and your position size calculation. It is the only place where the risk-reward math is genuinely knowable. Conflicts are inevitable. Perhaps your 4-hour chart breaks out bullish while the weekly chart is in a clear downtrend. Maybe the daily RSI is oversold and bouncing, but the monthly trend is still falling. When this happens, there is one rule: the higher time frame always wins. Research shows that counter-trend trades, entries against the higher time frame direction, lose money approximately 58% of the time. The lower time frame is allowed to veto a trade by disagreeing, but it is never allowed to override the higher time frame's trend. If your weekly screen 1 says the tide is falling, you pass on the 4-hour breakout. Missing a trade is cheaper than fighting a tide. Beginners often ask why we stop at 3 timeframes. Why not check 5 or 7? The answer is measurable. Adding a 4th timeframe improves win rates by only about 2%, but it increases your analysis time by roughly 40%. That is a terrible trade-off. 3 timeframes, trend, setup, and entry, strike the perfect balance between comprehensive coverage and decision clarity. 2 timeframes work, but miss the precision layer, while 4 or more introduce conflicting signals and analysis paralysis. The professionals in that 2022 survey peaked at 3 timeframes for a reason. More information is not always better information. The most common multi-timeframe error is starting your analysis on the chart where you will execute. A trader who opens a 4-hour chart first sees every wiggle, every breakout, and every reversal candle. Their brain locks onto the most recent price action and constructs a narrative to justify trading it. This is tunnel vision, and it is responsible for more losses than any indicator failure. The 4-hour chart cannot tell you whether you're buying a dip in an uptrend or catching a dead cat bounce in a bear market. Only the weekly and monthly charts can answer that. Start high, go low. Never reverse the order. The second deadly mistake is switching timeframe combinations based on recent results. A trader uses the weekly-daily 4-hour sequence, takes 2 losses, and jumps to daily 4-hour 1-hour, hoping for faster signals. Then they take 3 more losses and switch again. This behavior destroys any edge because no system can be evaluated over 5 or 10 trades. Research on trading consistency suggests staying with one timeframe combination for at least 30 to 50 trades before drawing any conclusion about its fit for your style. That is 6 months of disciplined execution for a swing trader. There are no shortcuts, only discipline. Here is a practical workflow for your trading day. Step 1. Open your highest time frame, monthly or weekly, and state the trend direction in 1 sentence. Step 2. Drop to your setup time frame, the daily, and identify the nearest support or resistance zone where a pullback might end. Step 3. Drop to your entry time frame, the 4-hour, and set an alert for when price reaches that zone. Step 4. When the alert triggers, look for a confirmation signal on the entry time frame before placing the trade. Step 5. Set your stop loss below the confluence zone and your target at the next higher time frame resistance level. This takes 10 to 15 minutes per stock. The waiting takes much longer. Multi-timeframe analysis is not a strategy. It is a filter. It does not tell you what to buy. It tells you whether the conditions are right to consider buying. The 4-layer hierarchy gives you a decision tree instead of a gut feeling. The factor of 4 to 6 rule keeps your timeframes meaningfully separated, and Elder's triple screen provides the intellectual architecture of tide, wave, and ripple. The BBWI case study proved that a stock can offer multiple high-probability entries when the screens align. And the S&P 500 case proved that the structure protects you when the tide turns. The discipline is not in the charts. It is in the sequence you read them. In our next session, episode 26, we are moving into volume profile and order flow. We will cover where the big orders are, how to identify value areas, and how to use the point of control. This is for advanced traders who are ready to see what really hides beneath the candlesticks. It is going to change the way you look at every chart you open. I will see you there.